If you're a real estate investor looking for privacy, anonymity, and a layer of asset protection, this is what I call the real estate nexus. We start at the top with a revocable trust. Now, this isn't for asset protection, it's for succession planning. If you pass away, your LLC avoids probate. That trust then owns holding companies. We use two separate holding companies. The left side is for passive income, like buy and holds. The right side is for active income, such as flips. Let's break down the passive side first. Your trust owns a co-holding company. That's a company formed in a state that provides charging order protection, which we'll break down in part 2. That company then owns property-specific LLCs, one for each rental. Each property holding LLC must be registered in the state where the property is located, or you'll need to file as a foreign entity. This holding company is taxed either as a disregarded entity or a partnership, depending on how many members are involved. On the active side, your trust also owns a second holding company. This holding company owns your Flip 1, Flip 2, and short-term rental LLCs. This holding company is taxed as an S Corp because active income is subject to self-employment tax, and the S Corp structure helps reduce that tax burden. The trust also owns a property management company structured separately from both holding companies. It might be taxed as an S Corp or C Corp. C Corp if you want fringe benefits like health insurance. And make sure you have the right type of insurance. Property insurance for the building, liability insurance to protect against lawsuits, umbrella policy to cover the gaps. We may consider irrevocable trust for true asset protection if your portfolio or situation warrants it.
I like the fact that she's showcasing structure here, because structure makes a lot of the objectives possible. Let me explain. When I'm dealing with business owners and real estate investors and high-income W-2 earners, I teach them something called the real wealth matrix. It incorporates trusts and holding companies and operating companies, family management companies, and special purpose entities. And it is a bit different than what's being showcased here. And in certain circumstances, I actually use different types of entities than are being described here. As an example, when debt is involved in real estate, we utilize land trusts. And we do that because we don't want to triggering the due on sale clause when we're transitioning assets from one ownership type to another. And when we're dealing with investors that own a lot of real estate, we may not wish to have separate LLCs around each individual property. Instead, we may opt for something like an equity at risk or an equity exposure, where we just aggregate the amount of properties that would total the amount of equity that we're willing to put at risk. This way we minimize the administrative burden when you have a lot of volume of properties that you own. If you want to win at the game of business, you need to understand the rules. If you want to learn what some of those rules are, just drop the letters GOB and I'll send them your way.